Tuesday evening. Okay, in a fine position now, at least stable and good for the bulls. Let's get our market master for the day into the show. Vetri Subramaniam, Chief Investment Officer of Religare Invesco Mutual Fund, joins us. Good morning, Vetri. Good to have you with us after a very long time, it seems. Well, first, lay out for us how you look at the global cues. Do we not worry about Greece? Will there be any outgo of funds because of the Fed?
Yeah, good to be here, Lata. Well, I think, Greece is obviously the topic which is dominating a lot of the discussion right now. But to keep things in perspective, I think, Greece in terms of the size of the economy within Europe, it's, pretty small. In terms of the total sovereign debt outstanding, even within the European region, if I remember right, it's well less than 5% of the total sovereign debt outstanding. And unlike 4 years ago, when there were genuine fears that a lot of the Eurozone banks had exposure to Greece, as a result of the various bailout packages that the ECB along with the EU has implemented, most of that exposure has now shifted to the ECB itself. So I think to that extent, Greece itself is a bit of a sideshow. Obviously, in that country, this is a very trying period that they are going through. I think from the point of view of global markets, the bigger issue will be that of contagion. If it does come down to Greek exiting the euro, what safeguards and what mechanisms are there in place to prevent that risk from then conflagrating across some of the larger economies within the European region, primarily Italy and Spain. Both of which have fairly significant levels of debt. Multiple, Italy's debt outstanding is 8 times that of Greece. So I think that is really the key. How well can the EU and the ECB put in place a firewall if a Grexit were to happen? And mind you, that is not a given either, because as you're well aware, the polls indicate that actually the Greeks may not necessarily be in favor of exiting the euro region and the euro currency.
So how should we look at the global markets at all and the fund flows picture? Will we get any accidents of major outflows, or will there be very big inflows?
It's hard to draw a causality, straight line between these events, but I think, what history tells us, and, I've been in the market 23 years, we've looked at the 94 tequila crisis coming out of Mexico and LATAM, 97, 98, we had the Asian crisis, then, in the 2000s you had the dot-com meltdown, then later you got the global financial crisis. So look, this is a repeating pattern which happens every few years in global markets. I don't think it's something new, and the bottom line is that whenever any of these asset classes gets disturbed in a very significant way, there are drawdowns that happen in other asset classes as well as a corollary. So while this time around the focus might be on bond markets, history tells you that it doesn't matter which asset market is disrupted, the other asset markets also see a cash call because people are trying to rebalance. So I think from that point of view, if there were to be conflagration, you should worry a little bit about the scope for money to get pulled out of all equity markets, and I think all equity markets will be at risk. And as I said, you've got enough incidents in the past that tell you that this is a concern. I think the bigger issue is whom should this be a concern for? It's obviously a concern for people who are trading the markets on a very short-term basis. But I think for people who are willing to look beyond this and who have the sagacity to realize that these kind of issues, keep occurring, with almost, fair deal of regularity, you should, learn to live with this volatility.
Vetri, that was very well put. So focusing on our own markets, I think since the last time we spoke, we've seen a 10% fall in the markets and nearly 4 months of time correction. Have we put in a bottom in place? How do you expect the Indian markets to perform from here on?
Look, I think, the only thing that I go back to in terms of, looking at markets and looking at what it's done historically is in the context of valuations. And when I look at valuations, yes, the market has sold off 10% from the peak in terms of price. And there has also been a correction in terms of valuations, but it's not as dramatic as what has happened to prices simply because the fourth quarter earnings were a washout and they were actually negative year on year. So when you look at it from a valuation perspective, I think at peak in Feb-March, the market was at almost a 27-28% premium to its long-term trailing multiple on a PE basis. We're now down to somewhere closer to about about a 20% premium. It's not really what I would call particularly attractive or cheap. If it came back to average, then I would start to consider it far more attractive. But it's not ridiculously expensive either. So what we've been telling people is that, look, these valuations are reasonable. They're not particularly cheap. So the only way to sort of build your exposure to the market is through a gradual process. There's no incentive to take a very dramatic asset allocation call in favor of equities at this point of time, because the valuations aren't really what we would describe as being attractive. Regarding the sell-off that's happened over the last 3 months, the only thing that I can see as a portfolio manager is, compared to 4 months ago, we're seeing a lot more companies where valuations are looking attractive on a relative basis, maybe not too much appearing cheap on an absolute basis, but relative valuation comfort is a lot more that we have today compared to 4 months back. So as a fund manager, our job has become slightly easier, but from an asset class perspective, I'd stop short of calling it particularly attractive.
Okay, then let's look at the earnings cycle itself and future valuations, therefore. Okay, not valuations as much as earnings. Do you see any improvement in earnings in the current quarter itself?
That's a good question, Lata. And I think sequentially you will start to see a little bit of a pickup in the numbers. I'm sure you guys have discussed some of the recent macro data trends that have been coming out in the first quarter of this financial year. All of it suggests there's a little bit of an improvement wherever we look. So I think sequentially, certainly there will be an improvement from the fourth quarter. Look, the fourth quarter of 2015 and the fourth quarter of 2014 were complete disasters in the sense that government spending came to a complete halt, and I think cash flows also came to a complete halt because the government just completely pulled back to get to its fiscal target. This year they're starting on a much better note in terms of their fiscal comfort. I think therefore the assumption hopefully can be that they won't have to slam on the brakes as hard as they did in the last 2 years, and therefore I think sequentially there will be an improvement. You talked about forward earnings, Lata, and I think the challenge there is that the market consensus estimates are already calling for 17-18% earnings growth in 2016. Now that still seems a little bit of a challenging ask because it's not visible that the economy has enough momentum at this point of time to get there. But sequentially, I do suspect we'll see an improvement compared to the March quarter.
But if the